In today's episode of the Rental Market Update, we are looking at the Jacksonville rental market for conventional multifamily properties. So you can see where the Jacksonville metro statistical area is drawn out by CoStar. Keep in mind that the city of Jacksonville encompasses the entire county of Duval County, up in the northeastern section of Florida. It is the largest city by area in the entire country, primarily because it is encompassed by that entire county. I do believe that the MSA extends a little bit past that county, so I think it encompasses a couple of counties here, not just Duval. So you can see where it's located. We have Orlando, Florida, down to its south. Here is Gainesville, home of the Florida Gators. Tallahassee, home of the Florida State Seminoles. We've got Atlanta up here. Charleston, South Carolina is over here. Birmingham, Alabama, and of course where I live in Mobile, Alabama, with New Orleans off here to the far west. So this gives you an idea where it's located. Let's take a look at the filters and see what we are excluding. So as usual, we're excluding all corporate, military, senior, and vacation housing, and we are only including market and market affordable rents. So that way we are only looking at conventional apartments. When we look at our location, we can see that we are in market, metro statistical area for Jacksonville, Florida. So let's go take a look and see what all three asset classes combined will tell us in the analytics, and then we will look at each individual asset class. So let's go take a look at our supply side snapshot. So here is the supply side snapshot for the Jacksonville metro statistical area. You can see that there are 1,293 total conventional properties in the marketplace, totaling 114,939 units. There is still 9,275 units under construction, and in the last 12 months, only 1,103 more apartments rented than went vacant, where in the prior 12 months, 4,146 more apartments rented than went vacant. So we've had a major slowdown in what we call absorption. We can see that in the vacancy rate, where we had a 6.6% vacancy a year ago, and today we are at 10.1%. We do have a slight increase in year-over-year rents. So we were at $1,461 a year ago, and we have gone up to $1,483 ever so slightly year over year. We will take a look at it quarter over quarter and see where the trend is taking us. As usual, we are not looking at the capital market. We are only looking at the space market. So as we scroll down, you can see that over the long-term occupancy average of 22 years, Jacksonville likes to be right at about 91%, and it is currently under the long-term occupancy average, sitting right on about 90%, just a little south of that 90% mark. So when we get to the end of this video, I will pull up the market cycle chart and we will plot where the Jacksonville metro statistical area is located on the market cycle chart based on our data. But let's go take a look at the data and see what the data tells us for first all three asset classes, and then we'll look at the data for each individual asset class. So let's go take a look at the data now. So here is the rent analytic data for the Jacksonville metro statistical area. We are not looking at asking rents. We do not care what the owner is asking. We only care what they are collecting. So we are only looking at effective rent. So we started the first quarter of 2022 at $1,462, went up to $1,499, and then as with most markets, in between the second and third quarter, we started to see the downtrend. Went down to $1,481, went all the way down to $1,459, actually below where it was in the first quarter, and then we had an uptick, according to CoStar, for the month of January to $1,468. CoStar has said that the January data is clean and is ready to go, and has reported that overall nationally we did see an uptick in rents. But let's see if our absorption or our demand shows that that uptick should have occurred, because I've seen this in quite a few markets now where they're showing this uptick, but the demand is not shown that that uptick should have occurred. So we can assume one of two things. It's either erroneous data, which is probably the most likely because it's very early on in the quarter to get this data, or the owners raised the rents because there was a better feel in the marketplace than we had in the previous quarters, even though the previous quarters showed a proper adjustment to rents based on demand. So let's go take a look and see if this follows the correct trend or if it's been following the same trend of just going up on its own. So we had 1,921 deliver in the first quarter and only 500 absorbed. Not a good absorption at all, but it bounced back in the second quarter with 306 delivering and 464 absorbing. Now, in no way did it catch up to the previous quarter. And if we go back even a quarter behind that, the market is way behind in catching up for the amount of units that are being delivered, and we can see that in the occupancy. We went from 94.3 to 93.1, but then we had that slight uptick of 0.2% because we absorbed more than we delivered, so we went up 0.2%, but then things started to go pretty bad. So we delivered 2,363 units, and another 37 went vacant on top of that, so we actually dropped 2% in occupancy because of it. Then another 1,406 delivered and only 74 absorbed, dropping that occupancy another 0.9%. And then here's the interesting thing. So our rents are telling this story for first quarter, second quarter, and then we had the drop in the third and fourth quarter, as it should have. But then if you remember, we had that slight uptick in rents for the month of January from 1,459 to 1,468. But if we look at demand, we delivered 916 and only 463 absorbed. So just a little bit better than 50% absorption, and occupancy ticked down. And even though occupancy ticked down, the rents went up a little bit. So as with most of the other markets that we've seen, a little bit of an erroneous indication where rent should have gone down, they went up. So once again, was it the owners just raising the rents, or was it is the data erroneous because it's still pretty early? I'll let you guys make that decision. I'm not going to assume one way or the other, but let's look at the other asset classes individually and see if one is driving this that direction or if they're all three following the same trend. So let's go take a look at Class A first. So here is our Class A rent analytic data. There are 76 properties totaling 20,271 units. We started, and again, we're only looking at effective rent. We started the first quarter of 2022 at 1745, went up to 1801, and then as with the rest, that downtrend started down to 1765, down to 1732, and then that little uptick in the first month. So let's see what deliveries and absorption tell us. So we can see that 419 delivered in the first quarter and 328 absorbed. So not too bad of an absorption on that number. Then 0 delivered and another 304 absorbed. So good, strong absorption for the first two quarters. Then we had 696 deliver and only 177 absorb. And so we had that downtick in occupancy as we should have. Then no deliveries, another 124 absorbed. So we had a little bit of an uptick, and then another little bit of an uptick with another 42 absorbing in the month of January. So for the Class A's, the demand says that we should have had a slight increase, and that is what this is showing. So interesting that the Class A is reacting appropriately. Now here's what's interesting. We have all this slowdown in absorption, and anybody can see this information that's paying attention to it, yet it looks like about 280 units went under construction between the fourth quarter and the first month of January, between fourth quarter 2022 and first month of January. New under construction units. That is an interesting tale, folks. That means that whoever is assisting the developers and giving them the data on demand and supply is not representing their developer very well. Because if I was a developer, there's no way I'm building seeing this information. Okay? So that's interesting. We haven't seen this a lot, but that's an interesting tale. So Class A's reacting appropriately to demand supply. Let's go see what the Class B story is telling us. Here's our Class B rent analytic data. We have 339 properties totaling 59,334 units. Looking at effective rent starting in the first quarter, we were at 1514, went up to 1541, and then as usual, that downtrend starts between the second and third quarter. Third quarter, we go down to 1526, fourth quarter down to 1502, and then a little slight uptick in the first month of 2023 to 1506. Let's see if demand tells us we should have had an uptick in the B's like we did in the A's. So 1,501 delivered and only 369 absorbed in the first quarter, causing that occupancy to go down as it should. Then 306 delivered, 389 absorbed. Good strong absorption and occupancy went up 0.2%. 1667 delivered, only 112 absorbed. Occupancy went way down. 1406 delivered, only 213 absorbed. Occupancy went way down. And then 916 delivered and only 494 absorbed, and occupancy went down even again. So the Class B's, even though we had slowing in absorption, though there was a little bit, occupancy still decreased, yet the rents increased. So where the A's followed demand trend, the B's are going in the opposite direction and going against demand trend for that first month of January. So first four quarters responding appropriately to demand supply fundamentals. Fourth quarter, we saw an uptick in rents where we should not have because demand dropped in the first month of 2023, did not increase. So interesting tale there. Let's see what the Class C story is telling us. So here is our Class C rent analytic data. There are 767 properties totaling 35,189 units. We are looking at effective rent, and in the first quarter of 2022, we were at 1146, went up to 1187, and interestingly enough, between the second and third quarter, we saw a downtick in rents. We haven't seen this a lot in the Class C market. In a lot of markets, we see that uptrend happen all the way up the board. So interesting that Jacksonville seems to potentially be following demand principles, but we'll see when we get over there. Then down to 1168, and then a pretty big jump to 1188 in the first month. That $20 jump, that actually goes above where it was in the second quarter. So really interesting here. My guess is that vacancy is probably increased across all 5 data sets, and this was an erroneous jump. Again, could be because owners were just jumping it, or there was demand for it, or it's erroneous data. But let's go look and see if there's demand for it first of all. So let's just look at absorption this time, because we should not have deliveries in Class C. As I suspected, the last time we had positive absorption in this market was 2021 quarter 2. Since then, the renters have said, look, these rents are too high. We're done. We're moving out. We know people are moving to Jacksonville. It's had population growth, but what's happening is the renters are roommating up, or what's known as doubling, and we can see that occupancy has gone all the way down to 91.6. Now, because it was at 91.8 in the fourth quarter, there is no reason whatsoever those rents should have went up $20 in the first month of January. So that is definitely either an unethical practice by the owners, just raising rents because there was a feel good in the month of January because of the data and what was going on in the news and the marketplace, or it's erroneous data by CoStar. We don't know the answer to this question. What we do know is that we are seeing a steady decline in demand in this market. So these rents will continue to make a downward trajectory. All right. So the Class C is definitely doing the worst of all 3 asset classes in the Jacksonville market. So What does this mean for Jacksonville? Well, let's pull the market cycle chart up. And if you remember, we were 1% below that occupancy average. And since we have deliveries, we would go under construction here. Because we have deliveries and we have absorption slowing in 2 of the 3 asset classes, completely negative in 1 of the asset classes, the rent trends declining in the 3rd and 4th quarter. I don't think we can look at that 1st quarter and say that uptrend meant anything except for maybe the Class A's, that I'd be pretty comfortable putting the Jacksonville market right here on this point in recession. So I would call Jacksonville in the recession phase of the current market cycle. Now, again, that is only for conventional multifamily apartments. That doesn't mean it's in recession for retail or industrial or single family or low income or student housing or senior housing in the multifamily space. Only for conventional apartments for the Jacksonville metro statistical area. So we are going to plot it right here in recession. All right, so that completes the Jacksonville metro statistical area. Stay tuned for the rest of this week. Tomorrow we are going back to Texas, and we are going to look at the 4th major metro since we started these videos and see what San Antonio tells us. Then we're going to come back to Columbia, South Carolina, just north of this Jacksonville market. Then we're going to go take a look at Walmart in Northwest Arkansas and finish the week with Albuquerque, New Mexico. So I look forward to seeing you guys tomorrow.